Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures getting a boost this morning after the White House revealed the U.S. and China will meet over the weekend. The meeting marking the first confirmed trade talk since President Donald Trump's tariff announcement on April 2nd, which sent stocks plunging. The Treasury Secretary will partake in the meetings, which will focus on de-escalation rather than one big trade deal.
Plus, investors are awaiting the Federal Reserve rate decision that comes today. The central bank expected to leave interest rates unchanged, a move likely to frustrate the president, who's called for lower rates. Now, officials have stressed recently that while uncertainty is high, monetary policy is in a good place to balance the Fed's goals of maximum employment and stable prices. All eyes will be on Chair Powell's press conference.
And Disney soaring this morning after raising its full-year profit forecast and beating quarterly estimates. The beat and raise coming after a number of major companies have pulled their guidance amid the uncertainty caused by President Trump's trade war. Disney is benefiting from faster than expected growth at its parks and streaming business and pointed to that strong performance to boost its guidance. The Federal Reserve is widely expected to leave interest rates unchanged later today, but investors will be closely watching Fed Chair Powell's speech at 2:30 p.m. Eastern for insight into how the central bank is navigating the impact of tariff policy on the U.S. economy. Joining us now is What to Listen For, Fed correspondent Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. That's right. Investors will be listening closely to Fed Chair Jay Powell's press conference this afternoon to see if his views have evolved at all on the central bank following President Trump's repeated calls for preemptive rate cuts and threats to fire the Fed chair. Trump in recent weeks has referred to Powell as, quote, a major loser, Mr. Too Late, and a total stiff in a series of social media posts. He has also said that Powell's, quote, termination cannot come soon enough, before later clarifying that he has no intention of removing Powell before his term as chair is up next May. In the months ahead, Powell and other Fed officials expect to wrestle with which side of their dual mandate to focus on, inflation or maximum employment, as Trump's tariffs potentially push inflation higher and possibly act as a drag on economic growth. Market watchers expect Powell to reiterate that the central bank will hold rates steady until they gain more clarity on the impact of Trump's policies. One thing to watch for is whether Chair Powell takes more of a hawkish tone, if nothing but to keep long-term inflation expectations in check. The Fed views that as critical as consumer expectations for inflation in the short term have shot up. And based on one survey, the University of Michigan survey, long-term inflation expectations have also moved up. Expect Powell to shy away from the notion of preemptive rate cuts as well, something that President Trump has repeatedly been pushing the Fed for. The Fed would really need to see a deterioration in the labor market for them to begin cutting, though it would be good to look for whether Powell lays out any possible scenarios of what that might look like, akin to what Fed Governor Waller has laid out. Back to you.
Jennifer, while we have you, turning to the trade front, Treasury Secretary Scott Bessent announced trade talks with Chinese officials will take place this weekend. What do we know there?
It's so funny, Brad, because yesterday when Treasury Secretary Scott Bessent testified on Capitol Hill, it seemed like the notion of talks with China were nowhere on the radar. Then last night, we learned that Treasury Secretary Scott Bessent and U.S. Trade Representative Jamison Grier will travel to Switzerland and speak with their Chinese counterparts this Saturday and Sunday. We learned initially in guidance from the U.S. Treasury and the USTR through twin press releases last night that both gentlemen will be traveling to Switzerland starting on Thursday to meet with Switzerland's president to talk about trade and leveling the level the playing field for trade as part of all these trade negotiations that are going on. At the same time, they learned that the Chinese would also be in Switzerland, and so that's how talks came into being. We later learned from the Treasury Secretary, who appeared in an interview on Fox News, that these are going to be initial talks. They're going to talk about what to agree to talk about. This is more de-escalation versus the so-called big trade deal. Bessent telling Fox News that, quote, we have shared interests. This isn't sustainable, given that tariffs are 145% on China, that we don't want to decouple from China, and what we want is fair trade. Now, Bessent is set to testify before the House Financial Services Committee at 10 a.m. this morning, where he is sure to be peppered with many questions on this topic. Guys?
Jennifer, you mentioned that it is funny, but a lot of nervous laughter happening right now as we're waiting.
Wall Street is relieved, right? They're breathing a sigh of relief.
Exactly. Here, thanks so much, Jennifer. We'll be checking back in later on. Stocks getting a lift on hopes for trade progress when the U.S. and China meet over the weekend in Switzerland. But is there any material change for investors who are worried about headwinds from the trade war? Joining us now, we've got Ed Yardeni, Yardeni Research President. Ed, great to have you here with us. As we're waiting for details to really emerge from either side, because there have been very different narratives that both countries and multiple countries are really telling when it comes to how they're going about negotiations and whether talks have actually started or not. What will be the material driving force behind these deals from your perspective?
Well, at the end of the day, it's going to be up to President Donald Trump whether there are deals or not. I mean, yesterday, he sounded like he was ready to declare victory, that he would entertain the possibility of having deals that weren't in writing. I think he's got to get this issue behind him by the summer. I think there will be deals. Some of them will be a couple of pages long, and there'll be frameworks for discussing, for further discussions, and they'll be signed. Others will just be verbal agreements. I think there will be some sort of modus operandi with China, but Trump really can't afford to have this all lead to a recession in the second half of the year and into next year. And the reason for that is that the midterm elections are coming up. God bless America. We have a system called checks and balances, and it works great. Any administration has to consider not only the next presidential election, but the midterms. And so that's an issue. And the Chinese are also under a lot of pressure to get this thing resolved, because there are already some reports of social unrest from people that aren't getting paid and are losing their jobs because they're losing the American market.
So Ed, talk to me about this kind of being a slow-moving barge. When I talk to my sources in Washington, they point to the fact that this took years the first time Trump was in office in terms of getting a deal with China. How do you trade around that uncertainty?
Well, I think that the markets have figured out that that's what you've got to do, that the uncertainty, the volatility, the fact that the president makes a comment every day that seems to potentially be market moving. I think at some point the market starts to move on and focus on other things. Let's not forget that some of this correction we've seen in the S&P 500, and it was a correction, it wasn't a bear market, and I think the bull market is resuming, but let's not forget that some of it had to do with questioning about AI infrastructure spending. It was the Magnificent Seven that really were down 25%, bringing the market down 18%. And the reason the Magnificent Seven got basically into a very short-term bear market is DeepSeek was introduced in January and raised questions about whether these companies were spending money that they were never going to get any return on. And now with the earnings reports, they're making it clear that they think they're going to move forward with their spending and that they will get a return on it.
Doesn't that pose kind of a double whammy, though, if you have on one end the additive competitive threat, of course, which is natural in any open market, but then you also have, which is what the markets were clearly moving in more outsized fashion on, Liberation Day comments, and then we're starting negotiations or pausing the tariffs for 90 days. And that was some of the more severe price action correlation that we were watching here. And so that in mind, I guess the question is, when you have kind of that double whammy of both, you're also now sucking out some of the potential growth for those semiconductor names that had really been the kind of poster children for the rally that we've seen over the past 2 years.
Well, the data shows that spending is still quite strong in the technology area. I mean, the earnings reports didn't indicate that anybody was really cutting back on their capital spending budgets. Look, AI is basically just an evolution of what I call the digital revolution. And the real what AI is really all about is increasing the demand for processing information data, and that requires more and more infrastructure. So it's really all about expanding the capacity of cloud computing, and I don't think that's changed at all. And then, of course, we've got a shortage of labor, which needs to be solved with productivity, and productivity comes from technology.
So just to clarify as well, I guess what I'm also asking here on top of that, though, is is it still as strong? Is the market still as wide for all of these companies if you also have a deglobalization effort that's taking place at the same time?
Well, again, I think we want to be careful about extrapolating short-term statements, short-term events for where this is all going. I don't really see this leading to deglobalization. I think we're going to be just seeing a greater diversification of supply chains. I mean, this has been going on for a while anyway, since Trump 1.0. Even under Biden, there was a move away from China to Vietnam and Mexico and Canada. I think what Trump is protesting is that the Chinese used some of these countries as back doors for dumping their products anyways in the United States. The Europeans are getting dumped on with electric vehicle cars. It's creating a real mess for their auto industry. So I think you're just going to see a lot of pushback, mostly against China. And I think overall, the global economy is going to continue to grow and be interdependent. That's just not going to change.
And based on your notes, I know that you do see the U.S. economy as resilient in the face of the tariff turmoil,
Yes.
but you do say a recession is still a possibility.
Sure.
On our Fed day here, I'm curious, is stagflation or a recession worse? Because with stagflation, at least the Fed could potentially, or with stagflation, the Fed has less room than they do in a recession.
I think in the short term, you're going to see more inflation than stagnation in the economy, and that I think keeps the Fed on hold for sure. In other words, I think the inflation rate, which is right now 2 to 3%, goes up to 3 to 4% pretty quickly here. That's been signaled by some of these regional business surveys of pricing. So I think inflation is going to heat up here. It's going to be kind of like a mini version of what happened during the COVID pandemic with supply chain disruptions. On the other hand, I think the unemployment rate is actually going to stay fairly close to 4%. That's not an environment for the Fed to lower interest rates. So I think the message from the Fed is going to be more of the same, which is they're in no hurry at all to lower interest rates.
Ed, we got to go. So that means probably not 100 basis points of cuts this year, right?
No, not at all.
Ed, thanks so much for taking the time this morning.
Thank you.
Disney shares are on the move after topping second quarter expectations and raising its full year outlook, citing strong performances from its theme parks and streaming business. The company adding 1.4 million Disney Plus subscribers in the quarter, bringing the total number of subscribers to 126 million. Joining us now, we've got Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geeta, great to have you back here with us. I just want to get your read in on these results.
Thank you, Brad. So this was really, A+ for Disney in terms of execution. So such strong momentum across all businesses, especially as you pointed out, both at the theme parks business. Remember, theme parks makes up about 55 to 60% of Disney's operating income. So extremely, extremely important to the company in the context of overall results. And also it's, so sensitive to the overall, macro trends as well as to consumer sentiment. So for them to come out and raise EPS guidance, this was supposed to grow high single digits. Now they've raised it to 16% growth is really telling. And then, of course, streaming as well. Yes, Maddie.
Thank you, Geeta. Sorry about that. I do want to talk more about the streaming, but in terms of the price action, I'm just curious, do you think that this is a little bit too optimistic with the stock over 9% up right now, given that it's still down 50% from its prior peak?
I don't think it's too optimistic. So they did, they have a very good growth outlook. And I think why that has managed to dispel so many fears is because, we were really kind of expecting this overall consumer slowdown to have a pretty significant impact on the outlook for Disney's parks. And, they kind of come out swinging and point to advanced bookings being up pretty substantially, both in fiscal third quarter as well as fiscal fourth quarter. And that's just not the macro economy. Remember, we also have a major competitor in Comcast's Epic Universe, which is just opening in a few weeks in Florida, and that's supposed to be a source of major competition. And for them to come out and give such a strong forecast, I mean, just points to the confidence the management team has and really kind of raises investor confidence across the board.
I guess another facet to this, too, is how Disney is gauging the interest and the demand for parks internationally, especially with the announcement this morning about extending the company's global reach, captivating new audiences with the 7th Disney destination. That's going to be targeting Abu Dhabi. So all of that in mind here, how do we get a kind of broader read on, or how investors should be grading Disney on bringing some of these new parks experiences to life over the long term?
Yeah, I think parks has really been such an underappreciated part of the business, Brad. And I think now investors are really going to be forced to pay attention. I mean, they have fantastic IP, they have a world-class brand, and the amount of investments that they're undertaking in that business, there's $60 billion that they've committed to grow capacity in the parks, to, increase the number of attractions across all of these different properties. And then you have them adding this 7th new destination in Abu Dhabi. They already have about 120 million visitors to their parks every year. Expect that to now rise pretty substantially with this new park that's going to come on board. And then you have them making really huge investments in their cruise ships. So remember, they just added their 6th cruise ship, and they're basically going to double their fleet capacity over the next 5 to 10 years. So again, we're looking at them basically doubling or maybe even tripling their cruise revenue. So across the board, again, with the theme park segment itself, we're seeing tremendous strength in the domestic parks. And then, of course, they're adding capacity, building out the footprint, and then doubling down on cruises.
Geetha, talk to me about the bigger competition or threat to the narrative you just pointed out. Is it the likes of a competitor through Universal with Universal Epic, or is it just an uncertain macro environment that could potentially lead to a slowdown in growth that could weigh on people spending money on experiences like the ones you just laid out?
Yeah, I mean, that is always going to be a concern, Maddie, with the theme park business just being so sensitive to consumer sentiment. But what we've seen so far is, the consumer is still spending, at least domestically. We're not seeing any signs of a slowdown just yet. Having said that, though, they did point out a slowing consumer in China. So if you just look at their international parks results for the fiscal second quarter that they just reported, they actually reported, a decline in operating income in the international parks, and that was because of the slowdown in Chinese per capita spending. So that is obviously always a risk. But if you just kind of look at the big picture, yes, we've had pockets where, they've had a slowdown with a recession, with COVID. But then if you just look at COVID, I mean, Disney basically came back stronger than ever. They in 2022, they just reported such a massive surge, in theme park attendance, in theme park revenue. And then with all of the operational efficiencies that they have kind of implemented over the past few years, we're seeing tremendous momentum in terms of operating leverage. We're seeing returns and operating margins being stronger than ever. And that's basically what they're kind of really focusing on over the next few years.
Geetha, just lastly, while we have you here, the direct-to-consumer entertainment segment here for Disney, this has been a massive area of contention, especially among activist investors over the past few quarters. We've seen some of those campaigns subside here. Do the results here in this quarter and the outlook going forward give enough to really kind of quell some of the concerns around their direct-to-consumer and specifically their streaming business?
Absolutely, Brad. So, we just saw them report for the first half of fiscal 2025 about $629 million in operating income just for the streaming unit. Remember, just a few years ago, this was a unit that was posting something like $4 billion in streaming losses. So this year, we're going to see, about $1 billion or more in operating income. But it's not about this year. It's about where this business goes over the next few years. If you just look at Netflix as a comparison, I mean, Netflix is guiding to something like 30% operating margin. Disney has 4% operating margin this year, potentially, but just look at where that could potentially go, right? We're looking at them potentially tripling, quadrupling, profits in that segment. So again, huge amount of upside, especially with their upcoming ESPN streaming launch a little bit later this year.
Geetha, great to see you this morning. Thanks so much for taking the time.
Thank you.
Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we break down the latest results from Supermicro. And a check-in on shares of NVIDIA. CEO Jensen Huang says China's AI market will reach $50 billion. We'll discuss that and much more on Morning Brief. Now time for some of today's trending tickers. We're watching NVIDIA, Supermicro Computer, and Uber. First up, let's talk NVIDIA. CEO Jensen Huang says that the market for AI chips in China could reach $50 billion in the next couple of years here. Speaking at the Mnuchin Institute conference this week, Huang spoke on why it's important not to restrict the flow of AI chips to countries like China, saying it would help bring back tax dollars to the U.S. and create jobs. Shares of NVIDIA here during today's session, you're seeing those up by about 0.1%, so some fractional gains here. His exact words were ultimately the Chinese market in a couple of years is probably about $50 billion. The market we've left behind, utterly gigantic, and compared it to the likes of Boeing. Boeing, I think last I checked, their market valuation somewhere around $140 billion, but yeah, you get the picture.
Yeah, no, definitely. And it's interesting actually to see NVIDIA just above the flat line, especially given that we're up on the day thus far. Kind of curious to see why it's not more of a lift, especially off the back of those earnings from AMD, which did indicate, well, it was a bit of a wild ride for AMD, which we're going to talk about, but they did indicate continued strength in demand, which would be a positive catalyst for the likes of NVIDIA. Having said that, of course, AMD did warn of tariff concerns, so that, of course, is also a concern for the likes of NVIDIA, and you could see that playing out in the price action here, those shares at 113 right now. Next up, Supermicro Computer cutting its full-year outlook, citing economic uncertainty and none other than tariffs delaying customer orders. The server maker reporting fiscal third quarter results. They came in below analyst expectations, but weren't in line with preliminary results released by the company last week. Supermicro also issuing disappointing guidance for its current fourth quarter. You can see those shares down 6%, which is really interesting because of what I just said. They gave the audience a preview of the show. They said last week, this is going to be a tough one, guys, and yet it wasn't necessarily priced in, at least to the degree of weakness that they did signal when cutting this full year outlook here.
Yeah, and kind of mixed reception from what we're seeing, at least in some of the analysts that cover this name as well. You got some initiation of coverage from Needham. They resumed their coverage, I should say. Positive outlook, buy rating, price target $39. Elsewhere on the street, you've got a lowering of the price target from Rosenblatt, and their price target has been adjusted essentially to $50. So that's just down from $55. So they're still net bullish on it, just kind of remodeling and being sensitive with exactly what's been set forth and how the rest of the street is perceiving some of the cut to this full year outlook as well.
Absolutely.
Also here, let's talk a little ride sharing. Uber missing first quarter revenue expectations and first quarter gross booking estimates as rideshare growth slows. Still, revenue grew 14% year over year. Taking a look at the shares right now, they are down by about 2.9% pre-market here as we're waiting for trading to begin. Of course, the CEO, Dara Khosrowshahi, offering a little bit more context and color of how he's looking at this quarter, supported by the consistent growth, strength of their core business. They continue to build towards the future. 5 new autonomous vehicle announcements just in the last week, he reminds as well. Also, $2 billion of quarterly free cash flow with multiple levers in their control to generate industry-leading cash flow growth, that coming from the CFO.
Yeah, it's interesting that falling shy of anticipated revenue growth seems to be the sticking point here, given that just a year ago, Uber had a loss in their quarterly report here, their net income around $1.78 billion or 83 cents a share for the first quarter here. That is up from a net loss of $654 million a year earlier. So certainly seeing that recovery, and you can see that playing out in the price action on your screen here over the course of the last year. What's interesting to me is we talk constantly about whether or not we're in an economic slowdown phase, and we didn't see huge signs of that in Uber's report here, and also in terms of the analyst commentary talking about how they do see strong consumer demand going forward for this name. You can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead. Stick around. You're watching Morning Brief. You are just seconds away from your opening bell on Wall Street. Taking a look at live images from the New York Stock Exchange. and the NASDAQ over in Times Square. But let's get you a check on the markets this morning because I've got some good news to report. We are starting to see some signs of green. This, of course, coming after reports that the U.S. and China are set to kick off some of those trade talks. And of course, what's interesting, and according to the sources that I've been speaking with down in Washington, is that trade talks between the U.S. and China can tend to take years, not seconds, which is what the market would be hoping for. Nonetheless, we are seeing futures and the market opening here in the green. Taking a look at the S&P 500 above the flat line, it's up about 0.1%. Your tech-heavy NASDAQ barely holding on to gains. It's up just about 0.1% this morning here. And taking a look at the Dow moving to the upside as well. Quickly want to check in on how we're doing when it comes to Treasuries. Taking a look at those yields coming in just a bit, perhaps a teeny tiny bit of a bid in Treasuries with your 10-year note holding above 4.31 for the moment. Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Maddie, for spreading the good news here about the S&P 500. I'm going to show you a year-to-date chart. Now, we are in the process of snapping a 2-day losing streak, but let's not get too celebratory just yet. We got a big Fed announcement later, and this is just kind of showing how we have entered this potential area of resistance, and there's just a lot going on in here. 200-day moving average is just above. That's a key technical level, and the S&P 500 is regrouping after that huge 9-day upsurge that we had just very recently. So let's take a look at the NASDAQ composite because that's in a very similar situation here. And then the VIX. Now I'm looking at the VIX in particular today because it is up 3 days straight. And usually when the VIX is up, we see stocks down, but that's not the case today. It's not a big movement, so I'm not making too much of it right now. But when these things get out of whack, these historical correlations, I do tend to pay attention. Sometimes volatility leads the way, sometimes stocks do, but something's out of whack right here. Let's move on to the sector action for today. I'll just go over that briefly. 11 sectors, 10 of them in the green right now, led by communication services. And I'll take a peek at the NASDAQ, and we can see Alphabet kind of leading the mega caps there up 1%. But I want to get to some of the leaders. This is what I've been focusing on this morning. IBB is a biotech ETF, happens to be green today, but I'll show you what happened yesterday. Had its worst day since March of 2020. So biotech got a little bit of a stumble yesterday, trying to claw back some of those gains today. Also taking a look at ITA, that is the U.S. Aerospace and Defense ETF from iShares. And that is clawing, it looks like I've stalled out here on the interactive, so I might have to send it back to you. But just to finish this thought train, I got it back. And I'll show you the year to date. We did break to new highs recently. We came back, tested the prior breakout level, and now we have jumped above that. So iShares and U.S. Aerospace and Defense ETF was one of those that fared really well in the decline. Didn't decline as much as the S&P or a lot of the other indices. So that's something on my radar. And then Chinese tech. Let's take a look inside China right now. Chinese tech overall, looking at KWEB, that is snapping a 4-day win streak. And I'm going to close here on futures where I want to point out the action in crude oil. Crude oil has been volatile recently, and I'll put a longer term chart here. Here's a 1 year, and you can see trying to find a bottom. It's been kind of sketchy. $60 price level was rejected just earlier this morning. So crude oil on top of my watch list for today. Guys.
All right, Jared, thank you so much as always. Appreciate it. It's time now for today's strategy session. Over the past few months, President Trump's trade policies, along with some other headwinds, have weakened the U.S. dollar against most major currencies, triggering doubt around the dollar's longstanding dominance. This, combined with record debt levels, could create a genuine financial crisis, according to our next guest. Joining us now to discuss, Kenneth Rogoff, a former chief economist of the International Monetary Fund and the author of Our Dollar, Your Problem. Ken, great to have you. Thank you for coming in studio.
Thank you for having me.
We appreciate it. So talk to me about the declines we've seen in the dollar. Was the dominance of the dollar already at risk prior to this administration, and what is that signaling to you?
So the dominance of the dollar, and we're talking about not just the level of the dollar, which I will say is super high still even after coming down, but how much it's used in trade, finance, what have you, like English. It actually was coming down for about a decade, at least by many measures that I look at. And I think there are a lot of reasons for decline. One is there's an appetite on the outside, particularly from China and parts of Asia, but Africa, parts of Russia, obviously, but Europe too, to have other options, not just for what things are denominated in, but for the financial system. You want to do a transaction that President Trump or the Americans can't see. There's a huge appetite. And I tell you, it's not just the Chinese. They don't like all this American control. So the most efficient thing is to have one currency, but not politically, not if it gives America too much power. But I'd also say on the inside, the internal problems with particularly our budget deficit, which I know people have been talking about for decades, but interest rates have normalized, in my opinion. Long-term real interest rates are probably higher for much, much, much longer. I've been talking about that and writing about it for a long time in my research. We had a big drop after the financial crisis. Happened many times. If you look at centuries, it's high, it's low, until it isn't. I mean, in the Great Depression, it was down around zero for a while also. So that, when you're the world's biggest debtor, that's a problem. And then if we lose some of our exorbitant privilege, which gives us a lower rate than we would pay otherwise, that's so much the worse. I think that was fading, not going away, but clearly got an acceleration under President Trump.
I wonder how you evaluate all of the flows into gold by central banks and how that creates more of a long-term headwind for the dollar right now.
Well, absolutely. For central bank reserves, gold has become a big option. The Russians have been doing that for ages. They've been absorbing their whole gold supply. The Chinese are doing it. Everybody's doing it. So that's not the main event.
Sure.
But in terms of, it's one of the signs of they're just trying to look to diversify. Now, over the long run, gold's not ideal. They'd like to have something more liquid, easily traded, but I think that'll come in time.
Would you mind breaking down for me, just in layman's terms, why we like to have the world's reserve currency? Like, why does that benefit us, and why might we not want to lose that status and that privilege, as you say?
So it benefits us in manifold ways, and not to pitch my book, but you kind of have to read it to read about it. But the obvious ones that I mentioned, you pay at interest rates that's lower than you would otherwise. It's a big market, it's so liquid, you feel safe. That was true when the UK was the dominant currency, and now we are. But there are lots of other things. So one thing is we are able to borrow a lot in a crisis, and there will be another crisis. And I don't just mean one that Trump causes, I mean a pandemic, cyber war or something. Progressives complain we don't borrow enough, but we borrow a lot more than anybody else does. And why don't the other countries borrow as much? Because they see their interest rates shoot up. Yeah. Ours go up, but more gently, although that has gotten worse as interest rates have gone up. There are more subtle national security things that are a big deal. A lot of modern spying is cyber. Somebody sitting with a laptop in a dark room and the CIA building, not the James Bond stuff. And a lot of that is what we get from the financial system. Everything flows through the United States because of our dominance, the dollar, our military dominance. So there are many things beyond that. So why might we not like it? And of course, the Trump administration has Steve Moran, who's a very smart guy, who's the chair, has said, no, it's a burden, it's terrible, it makes the dollar high, it deindustrializes us. And a short answer to, and it makes us run deficits. And a short answer to that, we've been the dominant currency for a while. We weren't running deficits in the 60s and 70s, and we were still the dominant currency. The UK was the dominant currency when, in the 19th century, when the sun never set on the British Empire, and they ran surpluses. There are, reasons for deindustrialization, which have to do with trade. There are many things that affect there are many things that affect our exchange rate. But the big point is that our trade deficit is basically how much the country saves versus how much we invest. Invest meaning real investment, plants and equipment, et cetera. Well, a lot of things affect that besides the exchange rate. One of them, what do you know, is the government budget deficit, which right now is higher than our trade deficit. So if I really cared about stability and this trade deficit, how about closing up the government budget deficit?
At a House meeting, committee hearing Tuesday, we know Treasury Secretary Bessent was asked about the X date here, the date where the U.S. government will reach its borrowing limit. I want to play a clip for you of what he said and get your reaction on the other side.
As an outfielder running for a fly ball, we are on the warning track. And of course, the United States government will never default. That we will raise the debt ceiling, and Treasury will not use any gimmicks. We will make sure that the debt ceiling is raised.
And so what is an appropriate level for the debt ceiling to be raised to, and how sustainable is the just continuous raising of the ceiling in order to accomplish what spending targets are also being put forward as well?
I mean, I think it'd be fine if we got rid of the debt ceiling. That's not really our problem. And the Treasury Secretary is right. We're always going to raise it. Yeah. The debt ceiling, sort of, I have a credit card bill, but no, I don't know if I want to pay it, even though I have a lot of money. No, the sustainability of the debt has more to do with, most of all, that interest rates have gone up. So back for a long time, it seemed like there was no, bill to pay. You just kept borrowing and reborrowing. You didn't even pay the interest. But now the interest bill, if you've noticed, has doubled, on its way to tripling. It's going to be more than it is more than the defense budget, on its way to $1 trillion. And that's when it gets less easy to borrow another 30% of GDP if there's a pandemic, to pay for something. There's a cost. You would rather have lower debt. I mean, there's nothing easy to do about it. But no, the debt ceiling's sort of theater and power grabbing. And maybe there'll be a slip sometime and we'll screw up and actually default. Great for sales of my book, but I don't think it'll ever happen.
Okay, well, that is at least some good news. I do want to bring us back to some potential bad news. What is your call on a potential recession?
So that is I think it's more than 50-50 to have at least a gentle slowdown. But we're trying to read into the mind of Trump, because, of course, if he really did an about-face on the tariff stuff, and I don't mean the 10%, which is maybe not the greatest idea, but just, the let's make a deal. Hollywood needs to be protected. Let's have a tariff on that. I was just in the UK, and you probably maybe reported on this, but he wants them to have free speech. And they're going like, we gave you free speech. We're the home of free speech. And a lot of the things are just, out there that they're asking for, sort of some MAGA wish list. And it's very disconcerting. Now, I have to say, a lot of people you probably talk to, big finance people and hedge fund people, and clearly the market thinks, he's a pragmatist at heart. He knows he's screwed up. I don't know if he knows he's screwed up. He's going to back off. And they just think it's going to go away. That I think if you did a poll, you can try it, of where are we going to be in a year, they'd all say 10% tariffs, maybe a little fluff with China, it'll all be over. I'm skeptical of that, and that's why I think the odds of recession are higher. I mean, Trump's still going to be Trump, for better or for worse. So I don't see an exit from the chaos. If there's no exit from the chaos, it's hard to see how we don't have at least a mild recession.
Is this a case where we need to see some of these smaller trade deals start to come through first, or does there need to be resolution on one of the larger trade partners out of the gates here to really set the tone? Because some could argue that he already kind of showed his hand, didn't want the stock market to go into bear market territory. That would have looked bad. And then additionally, you've got all the CEOs showing up at 1600 Pennsylvania Avenue's doorstep saying, hey, we're not going to have stuff on shelves in the summer if you don't step back off of this.
No, you are so right. That's what not just the market's thinking, that's what all our trade partners are thinking. Why aren't you seeing reports of, sudden deals? Because they don't want to, they can't for their own public. By the way, if Xi gave in to Trump and lost face, he'd be done. I mean, he cannot, any more than Putin, can surrender. He can't. So, everybody, my conservative friends, and I regard myself as a centrist, but my conservative friends will say, this is just the, art of the deal. Don't pay attention. And I say, okay, but when he was a real estate mogul, he was bidding on 100 things. If you got 3 of them, great. He got 3 good deals. He's making a lot of money. we can't walk away from the other 97 countries, in this case.
It's not a great percentage, yeah.
Yeah, it's not a good percentage when you're president. It was fine. It was a great, approach when you're a real estate mogul. So we'll see. If I want to say something that could turn in his favor and make him look amazing in 10 or 15 years, it would be that even though it's all chaotic and he's not always lasering in, China is our rival. They are down right now. He's hitting them while they're down. And if he didn't, there's going to be something over Taiwan. There's going to be a problem somewhere. And so maybe he'll say, oh, just a stroke of genius that he took him on when they were vulnerable. Xi fell and they got rid of Xi, turned in a more, I'm really playing this out, had a more democratic government. It all worked. And Trump, although he was so, brutal in his approach to trade, he got it done. Anyway, I'm an American. I wish well for our president. I hope that's what we're writing in 10 years.
Ken, thanks so much for taking the time here in the studio with us. You've been doing a lot of writing yourself already going into this new book. We appreciate you taking the time.
Thank you. Thank you for having me.
As we head to break, let's get a check-in on shares of Disney. House of Mouse jumping 11% at the open. After posting strong streaming and parks numbers in its latest report, the company raising its full-year outlook, and as you can see, investors, they're happy to hear it. Their ears perked up as much as Mickey Mouse right now. We've got much more ahead on Morning Brief. AMD shares pushing higher after the company offered an upbeat outlook for the most part. However, the company did warn that U.S. curbs on chip exports to China will mean a $1.5 billion revenue hit. Joining us now to break it all down, we've got Ruben Roy, Stifel's applied technology analyst who has a buy rating on AMD and $132 price target. Ruben, always a pleasure to grab some time with you here. And it seemed like yesterday there was a lot more of the pushback from some investors, at least early on, about what this would potentially mean in that hit in China. But AMD, I mean, do they have any answer for what's going on in China? Do they have a China problem?
Good morning. Thanks for having me. It is a problem, right? It's that's a big number. They talked about an $800 million write-off. We had written about this a few weeks ago, and obviously NVIDIA is going through, at a larger scale, the same issue with export restrictions on even I would say a lower class of chips, class of AI chips going into China, and who knows where that's going to stop, right? So does that, the question would be, does that eventually impact things like PC chips and other devices that AMD is shipping to China? Unknown. But for now, what we do know is, despite the $1.5 billion hit that AMD is taking on revenues for this year, the overall data center commentary and back half outlook were actually pretty good. I think going into the quarter, there was a lot of debate around AMD's positioning in AI relative to NVIDIA at the high end on the GPU side, and then some of the custom chips that AMD's customers are coming out with.
Yeah.
And I think, to a certain extent, that the company dispelled some of those fears. So I think it's a little bit better than, I think the debate's going into the print.
So upbeat forecast, shares rise. Then on the call, they talk about tariffs, expecting a $1.5 billion hit due to chip curbs. Where do you net out then?
Well, net out is, look, there's going to be tariffs, there's going to be export restrictions, and like I said, despite that, our numbers actually went up a little bit. I think consensus numbers didn't change much in terms of expectations, and so, the client side of AMD's business did quite a bit better, I think, than investors were thinking going into the print, and then gaming, of course, did better. Now, those are important segments, but the investor focus is certainly going to be on AI. And on that front, AMD has an investor event coming up in early June, and we're going to hear more about the product roadmap. For now, our belief is that while China's important, export restrictions are something to keep an eye on, the overall structure of data center spend in the U.S. and even beyond the U.S., it remains strong. A lot of the hyperscalers have already reported earnings and either maintained or even took up their CapEx budgets for this year. And I think that's a good setup for a lot of these AI component providers.
Yeah, and of course, an interesting setup for the likes of NVIDIA, which we are still set to hear from. Ruben, thank you so much for your time this morning. Appreciate it.
Thank you.
We're going to have all your markets action ahead here at Yahoo Finance, taking a look at the major averages still in the green this morning. Stick around. You're watching Morning Brief.
Time now for our chart of the day. Let's send it over to Madison Mills for a look at why corporate America is bullish on the stock market. Maddie.
That's exactly right, Brad. So taking a look at corporate buybacks, this is what it sounds like when corporate America buys back some of its own shares in companies, hitting a record high. We are on track for the second biggest monthly gains in corporate buybacks since the mid-1980s. Take a look at this chart here behind me. You can see the increase that we have had here, and that is on a monthly basis, that stat that I just pointed out. But you can see for the first quarter of 2025, we are nearing over $500 billion of corporate buybacks. The month of April seeing over $230 billion in buybacks, making up half of the gains that you're seeing on this screen behind me. So a couple of different takeaways for investors here. On the one hand, when companies are buying back stock, that can be seen as a positive catalyst because that means that companies aren't going to let their own share prices suffer too much off the back of any macro headwinds. We're facing a lot of those right now, right? But then there's a question. Is that the best use of companies' money on the balance sheet to be buying back some of their own stock? And also what happens if that money goes to waste? Does it overinflate stock prices and make valuations get a little bit unattractive? That is the question on a stock by stock basis. And also a question about whether or not the levels that we're seeing in the market right now, especially off the back of a little bit of a recent recovery rally, are those levels really an accurate picture of sentiment on the market when we know that sentiment amongst investors has still been a little bit bearish? Or is it something like buybacks and maybe some hedge fund leveraging and repositioning, making the market look a little bit better than it might be under the surface? Brad?
Yeah, it comes after an annual record for buybacks of $942.5 billion, according to S&P last year, Maddie.
That's exactly right. Well, that's going to do it for the morning brief. You can join me in the next hour for more analysis on catalysts, and then you'll have Brad after that for Wealth. Stick around.